We have the top team from the Motilal Oswal institution with us. 22nd Motilal Oswal Annual Global Investor Conference will kick off from the 17th of August. That is this coming Monday. And as always, for the curtain raiser, we're now joined by the two gentlemen who run it. We have Rajat Rajgarhia, whole-time director and CEO, Institutional Equities, Motilal Oswal Financial Services. We have Gautam Duggad, managing director and head of sales, Institutional Equities at the firm. Gentlemen, great to have both of you here. Thank you very much.
Prashant,
I was just wondering, it's like jackets versus bundis today, and Rima looking fabulous in a sari. But I want to say Happy Independence Day.
Thank you. Same to you and to all your viewers also.
So lovely to have both of you back here. It's also going to coincide with the wrap out of the earnings season.
Yep.
And what's happened over the last, I think, 1.5 odd years is that there's been some accident or the other, then the accident goes away. It was tariffs. Then the tariffs were not a problem. There's the oil price, and then briefly oil prices were not a problem. Markets reacted every time. But then as soon as there is a glimpse that things are resolving, markets snap right back. Rajat, I want to just start with that. Where are we at in this sort of game of... the point is that the index has not gone anywhere, although we've had these big swings on both sides. So why don't we start there, and then we'll get to the conference itself. Go on.
Yeah. No, I think that's fair. If you look at our markets, 2-3 years, index is quite range bound. The range is 3,000 points, but range bound. And two reasons I can think about it. First, the overall earnings has been little patchy. Only in the last 1 quarter, 2 quarter, you have started seeing things little better. And I think secondly, the narrative of global flows has always been more towards some dominant theme in the rest of the world, not towards India. And our markets, you can spend a lot of time on top down, but this market has become very bottom up. For the same index, if you can keep plotting charts or stocks, you will see many of the stocks just moving higher and higher and higher. So we are a very growth-oriented market. Wherever there is a growth, there is a demand. So that's point number one. Point number two, the two trends which I think are very visibly common. First, the retail money, the domestic money will keep coming in, not letting the market go down. And the primary market will keep supplying paper, not letting the market go up.
Correct.
So these two trends are also very common, right? And I think third thing is, we have started seeing now trends of earnings getting better. And I think this quarter, Gautam can speak more details, but this quarter has been where earnings have started becoming more broad-based, right? We don't differentiate too much like large cap, mid cap, small cap. We think growth is growth, whichever bucket they fall into, right? But we have started seeing breadth of the earnings being very good. So that's a good sign. This could just be a trend where after a 2-3 years of consolidation, you may start seeing India again taking
You've given me the perfect segue, Rajat, so let me take it to Gautam. Do you think we're at the phase where earnings acceleration can happen, or this quarter is more of a one-off? Or you think, we're set for, as Rajat put it, broadening of the earnings, and it's showing up in many places, but also continued acceleration?
So, Prashant, look at it this way. Last 1 year, we've had a lot of improvements in macro. Multiple steps that the government and RBI has taken in the last 9-12 months. You had interest rate cuts, GST cuts, right? And of course, government cut the income tax rate last budget. The cumulative impact of all of that is now getting manifest. You look at auto numbers data, credit growth, power, whichever segment you look at, GST collections. Despite the rate cuts, the GST collections were at a new high. And that is now transmitting into micro numbers. This quarter, everyone was expecting a quarter because of what happened in Iran and the geopolitical factors. Despite that, this has turned out to be the best quarters in last 3 years. In terms of quality, in terms of quantity of earnings, in terms of the breadth, whichever way you look at it. I have not seen a 20% plus earnings growth for last 12 quarters now. More importantly, the top line growth is at a 3-year high now. So inflation has made a comeback, which is now representing in top line across sectors. So for our coverage as of yesterday, 350 companies have reported numbers ex-OMCs. The growth is 23% in earnings against expectation of 15.
350 companies, 20% earnings.
23%.
23% top line growth.
Oh, this is earnings I'm saying. Top line is also 18-19%. Right? For Nifty, it is 18%. We were expecting 10%. Look at the other factor. We are seeing earnings upgrades now after 12, 13 quarters. We have seen a 2% earnings upgrade for our broader coverage and about 1.5% for Nifty, right? Like Rajat mentioned, it's a bottom-up market, right? After 3 years, we are seeing a turnaround in small cap earnings. We were expecting a 30% growth for full year, and the first quarter has given us that confidence that the full year can be met. The first quarter small cap earnings, and we cover a very vast numbers. You know, we have 180 small cap companies under our coverage. They have delivered 32% earnings growth.
Wow.
Mid cap 25%, which is why market is also representing that. You know, from the bottom, if you look at the March bottom, Nifty is up 9%, but mid cap 150 index is up 21%, and small cap is up 25%. And I think this trends will strengthen as we move forward.
But Gautam, for the full year, can we extrapolate these numbers for FY27 and FY28? 18-20% large cap growth, 25% mid cap growth, 30% small cap growth. Because in the current quarter, there was also that benefit of repricing of low priced inventory. So are these numbers sustainable for not just this year, but even say FY28?
So Rima, there is an interplay of that. Some sectors benefited because of inventory gains, and some sectors lost out because the inventory input cost went up. But when I look at the 31 sectors that we cover, 20 have beaten our expectations. 9 have met expectations. Only 2 have disappointed. I have not seen such a strong breadth in last 3-4 years. Now moving forward, when we started the year, we were projecting 14% growth for large cap, 21% for mid cap, and 30% for small caps. And like I just said, we have seen an earnings upgrade. So that basically means our expectations, which were there a month and a half back, have actually got more reinforced. So we are expecting to end the year on small cap with 30%, mid cap with 22% now, and large cap with 15%. Nifty will see 15% growth after 3 years. I mean, look at FY24, we did 1,000 rupees of EPS. FY26, we ended at 1,065. So in 2 years, we got 6% earnings growth cumulatively. And market has been absolutely fair. In 2 years, the Nifty market cap went up 5% from 181 lakh crores to 192 lakh crores. So market has respected only one thing in the last 3-4 years, which is earnings. Whether you look at last 3, 5, 10, whichever construct you create, we've looked at 5 different indices and their moments on last 3, 5, 7 and 10 year basis on EPS and index movement. It is matching 100% to the earnings growth. So if we are expecting a 15% earnings growth in Nifty this year and 20-30% in mid and small cap, I would think market is looking very constructive, and more so after 2 years of a very strong time and price consolidation. The only missing link, as we all know, in the last 2.5 years has been the flows. The FII selling has been massive. We are all aware about the numbers. In fact, on a decadal basis, they've become neutral now. Last 10 years, cumulative flows of FII is zero now. They've bought $69 billion in primary market, and they've sold exactly $69 billion in secondary market. So as and when that changes, you will see another tailwind coming in for the markets.
All right. Hi, gentlemen. Good to have you all in the studio. Well, a valid point, right? With regard to the flows, the FIs, they have not come to the party. Hopefully, that trickle that's been seen, that, just goes up from here. The other problem is when mood gets better, earnings get better, the market sentiment changes, then you'll have more amount of supply of paper. Could be good for business, but otherwise, that weighs as well, right? Barely in the last few days, we've heard a lot of IPOs, a lot of OFS, a lot of promoter sales as well. How big a problem is that? It could be good for business, I'm saying yes. But a bit of an issue for market sentiment, right?
Look, I think both yes and no. Yes, because of course things get bunched up. So if you look at from January to May, the primary market was almost very low. You hardly had paper. And suddenly things get bunched up. Now you are seeing maybe weekly basis, 3-4 IPOs, 3-4 QIPs, half a dozen, and this pace will continue. But it does very good to the markets over a medium to long term because of 2 things. First, the quality of companies which are getting listed now are truly representing what this country is growing. Point number 1. Point number 2, the wealth impact is getting more widespread because now you have bigger participation. Please remember, from a 2-3 crore demat accounts, today you have 25 crore demat accounts. Yeah. And with every one large IPO, you see more demat accounts being opened into the system. And lastly, I think for a lot of the money that offshore investors will put in, primary market will be an important source to attract that money. We have started seeing some of the recent IPOs. You see FIIs being anchor, QIPs, blocks, they're participating. So I think bunching up is an issue. Primary market supply is not. You need, in India, if you still look at a $5 trillion market cap, the free float is still relatively low compared to the rest of the world. But phasing out is what ideally needs to happen. It may not happen.
And I remember talking to Ramdevji earlier in the year, and he said that this year IPO, and that's the kind of market like last year was great for IPOs, and we were talking about, the capital market business, and he said, well, maybe this year is not going to be all that great, but look how it's turning out, right? It's back to being as busy as ever in terms of primary issuances, taking companies public, etc. Right, Rajat?
Yeah,
I think phenomenal.
I think Prashant, I always think this is very healthy for our and look at the kind of companies which are getting listed, from the largest asset manager to the largest exchange to the largest telecom company.
I mean, imagine a scenario where we were just talking about the same old 100 companies, right? Yeah. So the breadth, actually it's also the size, so the variance is amazing. Very large companies, smaller companies, but also the kind of companies, right?
I also wanted to highlight one point. When you look at the credit growth today at 18%, it needs to supplement with an equity capital markets, because for all the capex that we are beginning to see to happen, you need equity contribution to come. So that's why you are now seeing QIPs coming up big time, and QIP is the primary capital into the company for funding the growth, right? So I think primary markets are very supportive and important for the overall economy to grow. As I just said, we ideally phasing out is important, but our markets may not do that. So we'll weather this phase.
We have 4 or 5 managements waiting, so I'm going to rush you guys because I want to get just 2 more things. Gautam, earnings, right? You're a numbers guy, and you're looking at, and you said that, well, that's the only thing which matter, and markets have been very fair in judging stocks and what to do, what does well, not does well, based on numbers. Where are you most confident about? And in terms of earnings acceleration, based on what you've heard from managements in calls, etc., where there will be steady increase in earnings.
So, Prashant, that has not changed for us in the last 1.5 years.
Just revise it for us.
Yeah, of course. So, and that's also part of what we are trying to represent at our 22nd annual conference in the CEO track.
Yeah.
Right? India is a very diverse market. You have 5 big cohorts if you look at it: financials, consumption, tech, industrials, and healthcare. And one common thread running across these 5 cohorts over the last 2-3 years has been the big bellwether stocks in each of these cohorts have done pretty much nothing. When I was looking at bottom-up numbers for Nifty 50, there are 27 companies in Nifty which are almost stopped growing, or maybe growing at 5-7%. So real growth, even in the top 100 companies, is happening beyond Nifty 50.
Yeah.
So you have to dig there a little more. So where are we positive? If you look at financials, we are more positive on the non-bank side, both lending, non-lending capital market, which is a big overweight in our model portfolio. If you look at consumption, one good thing we did 2 years back was made FMCG zero. We converted all our 15% weight on consumption into discretionary, right? Industrials also, if you look at it, what is done well? It's not the benchmark stocks which are bellwethers in that segment. It's the power-oriented names, it's transmission, defense, likes of Dixon. They are the ones which are there in our model portfolio. Some of them are obviously representing in our CEO track starting Monday. If you look at tech, we've been consciously away from the traditional legacy large cap tech. We are more towards the new age technology. In fact, our coverage also has ramped up significantly out there, and we expect to have a far broader coverage in that domain. And lastly, Prashant, if you look at healthcare, the traditional top 5 large pharma generic companies which were there 10 years back, cumulatively over a 10-year period, they have compounded earnings at 7% and market cap at 8%. So if you have made money in healthcare in the last decade and maybe in the years to come, the money was made outside of the traditional generic names. So you have CDMOs, you have hospitals, you have diagnostics, all kind of names. And as a top-down thought, what we have done essentially recently in our own portfolios is we have moved almost 700 basis points of weight in our model portfolio from large cap towards mid and small cap. So largely consumer discretionary auto, non-bank financials and industrials. That's where we are more constructive.
We will talk more at the conference as well. It's a big one, as always, Rajat. I'm sorry, I wanted to talk about the conference, but we will pick up on some of these themes on Monday when we see you at the conference. Thank you both for coming and dropping by.
Have a good time.
Thank you.
For over 25 years, CNBC TV18 has been the guiding force for investors, steering them through the markets.
Start your trading day with cutting-edge insights and expert analysis.
Seize every opportunity by decoding the forces that drive the market.
Equip yourself with strategies and guidance from India's biggest market mavens.
Invest with confidence as we beam live from the CNBC TV18 Motilal Oswal studio.